All right. First of all, a huge thank you to TOKEN2049 for hosting this event, especially given how crazy the weather was today, and I hope everyone made it safely. Very excited panel tonight. We're going to start off very high level and let everyone introduce themselves as they take questions. And we have a lot of different projects both to shill, new product announcements. We have some great traders on the panel as well, too. So very excited to dive in. So this panel is very unique. You have folks who have been through, I think, if not 2, maybe 3 market cycles. And so as we're going through one now, Julian, I'd like to start with you to kick off. You've been through many of these market cycles. Can you describe a few themes and how liquidity has changed on-chain over these cycles?
Yeah. Hi, I'm Julian. I'm the CEO and co-founder of Aevo. Yeah, as Aya said, I've been around since like 2017, so 3rd cycle now. And yeah, I mean, I think in the 2018 cycle, like 100% of trading was happening on these centralized exchanges, mostly offshore exchanges, and it was sort of spot only. And I think in the 2nd cycle, which was the 2021, futures really started to take off. So perps really got super big. It was sort of orders of magnitude bigger than spot trading. And that's sort of where we still are today. But I think in the last 2 to 3 years, some portion of that volume has shifted from centralized exchanges to on-chain. So new exchanges are sort of appearing every single day in DeFi. Some of them are focused on spot, futures, options, all sort of the whole spectrum. And yeah, I think in the last 1 to 2 years specifically, the on-chain derivatives has started to pick up a lot. So yeah, I think that's sort of one of the bigger trends to look out for this cycle.
And how do you think about that, Cindy, relative to different chains? First of all, congratulations on the token launch this week. When you think about that specific to Solana, how have you seen that change over time? And how do you think about, as a builder, what chain to launch on to and the fragmentation of potential liquidity on chain?
Absolutely. So hey, everyone. I'm Cindy, I'm the founder of Drift. We're a perpetuals protocol on Solana. And that's a great question to start off. I think as new alt layer 1s have launched in the last couple of years, what we've seen with liquidity is that a lot of liquidities kind of started on Ethereum L1. And over the last, let's say, 2 years, layer 2s and alt layer 1s started popping up. So we've been seeing more fragmentation across different chains. And initially, it started off with AMMs in these different L1s and L2s, kind of having similar liquidity for the same assets. But as we started seeing more liquidity towards new innovations on Solana, for instance, new types of AMMs, new types of order book structures, a lot more liquidity has flown into places like Drift and Solana, especially post kind of the FTX incident last year. We're seeing it very sentiment-driven and very kind of points farming driven as well. So as protocols have gone into points, airdrop mode, a lot more liquidity is flowing into these places. But yeah, the environment on Solana has changed a lot since last year. Market makers have started gaining more interest again, and that's been the overall theme of liquidity this year.
And Annabelle, you sit in the perfect spot between seeing both DeFi, CeFi, institutional, retail. Can you talk a little bit about how that changes both on-chain, but also with the fragmentation? You know, a lot of times people are trading on-chain, maybe hedging in CeFi, and how that's changed, at least from your perspective at Amber.
Sure, yeah. Yeah, my name's Annabelle Huang, managing partner at Amber. And actually, before Amber, I was at a very early DEX. That was before Uniswap days. And I think the issue back then is, first of all, the infrastructure is not there. It was difficult for market makers to even kind of connect on-chain. Lack of custodians, lack of just reliable API infrastructure. That was back when centralized exchanges doesn't even have reliable API or anything like that. And then that's where I think Amber came in, trying to solve that, bring more liquidity, both on centralized exchanges and also on DeFi. But market makers were very liquidity driven, right? It's difficult to tell us to go trade on chain if there's nothing existing. So I think that's why I think the AMM model has really revolutionized a lot of this, bootstrapped initial, and then with infrastructure more built out, then more traders like Amber, like SCP are able to do a lot more on chain, and now it's getting a lot more sophisticated. There is sort of like the DEX centralized exchange arbitrage that requires a lot more infrastructure build as well. So you're seeing kind of different market makers focusing either like purely on centralized venues or on DeFi. But I would say there is still a big hurdle for true, like real institutional size to come into DeFi to stage. A lot of times we facilitate a lot of that at Amber because a lot of our clients, and these are like big hedge fund clients, they cannot get their compliance approval to trade directly on Drift or Aevo, or to stake some of these assets because of compliance issues or regulatory concerns. So I think the infrastructure is getting better. The willingness to trade is there, but I think the next hurdle is probably more so on how we can actually onboard these real institutionals.
Makes sense. And going to you, Kevin, you're uniquely positioned as a user, both on the CeFi side, the DeFi side, probably one of the largest funds trading both on CeFi exchanges and DEXs today. How do you view it from a user perspective in terms of maybe some of the challenges, things that have gotten better over time, whether it's capital efficiency, liquidity, segregated liquidity, and different chains and apps as well?
Sure. So, hi, I'm Kevin. I work at Symbolic Capital Partners. We're a crypto market maker that specializes in DeFi trading. In the last few years, I still remember when you had to create these very complex systems to access the most basic decentralized exchanges. And over time, the user experience has just become simpler and simpler. And while we're not quite there yet in terms of security or liquidity, I feel like the progress that's been made over the last 2 years is, hopefully a harbinger of more and more institutions, retail users, market-making firms continue to use DeFi as a venue for trading. I think some of the biggest differences are the supply chain of what happens when you click buy in your MetaMask or Coinbase wallet to when it actually the transaction gets finalized. This entire process has become more transparent, it's become more well-known, and previously there were all sorts of bad actors that were able to mess around with your information. And I think that if DeFi is to become the future of finance, we need to kind of continue to progressively improve the security, the transparency, and then the efficiency and the user experience for anybody who uses it, whether it's a retail user, a trading firm like ours, or pension funds and other institutions.
Absolutely. I would 100% agree with that. Going back to Cindy, you actually mentioned on the token airdrops, obviously right now it's the points farming is pretty big with the restaking narrative. Question for both you and Julian, how do you think about some of the marketing strategies or sales strategies or structuring even token strategies relative to liquidity on chain and even just garnering users to the platform?
The way that we thought about airdrops and farming strategy is a way to actually attract liquidity on chain. One of our core thesis is that market makers will come where takers come eventually, and we've seen that happen, especially on Solana with the meme coin craze. It's driven a lot of liquidity into this ecosystem because there's been traders. So when designing programs that incentivize trading, it's important to kind of distinguish between market makers and takers, because takers don't necessarily get incentivized by the same kind of linear rewards that market makers might be incentivized by. So there needs to be a lot more creativity in what they are interested in. If you think about what a trader likes, they like novelty. They would maybe prefer getting a Lambo as a prize rather than like 10 drift tokens, right? So, whereas market makers prefer rewards that are core to their business as their P&L balance sheet. So that's how we thought about it.
So more Lamborghini deliveries for taking. Julian, what do you think?
Yeah, I mean, I think exchanges basically are a marketplace where you have the supply, which is usually market makers, and the demand, which is usually traders. And the job of the exchange is to basically make sure these two, supply and demand, are growing in tandem. I think if you have too much supply and zero demand, you're sort of wasting the incentives that you have paid out. And yeah, so I think what we've spent a lot of time on is just like, how do we target our token incentives to getting as much organic demand as possible? And this can go wrong very easily. I think if you, for example, incentivize volume, you may get one guy doing $10 billion of volume in like 2 days. So yeah, I think a lot of work that we've spent is just trying to actually figure out like, how do we identify real human traders? How do we incentivize them to keep trading on the platform? And how do we grow the supply side in tandem with that as well? So it's sort of this like balancing game that you need to grow both at the same time.
Makes sense. And I guess as a user, I'm curious, Kevin, what do you see the differences in these different platforms and their approach to, whether it's token strategies or airdrops, points, and so forth?
Sure. So I feel like since the advent of AMMs, there's been a lot more iteration on different types of exchanges, market microstructures. It kind of feels like we're speed running the development of finance over the last like 4 decades, but in the last 4 years. And they're all just trying to cater to a different type of use case, whether it's a central limit order book, a perp dex like Aevo or like Drift, or some of the new mechanisms like RFQ, which are trying to give users more specific outcomes for whatever they're seeking. I can't say that one is better than the other. I feel like part of my job this year is to figure out which ones users do want to use and then allocate our resources in that direction. But what's cool to me is that there's a lot of experimentation, a lot of new builders coming into the space, trying to build on different platforms, build on different blockchains, create new mechanisms with all sorts of special characteristics to try to target their users.
Makes sense. And Annabelle, curious, from your perspective in the conversations that you're having today, are you seeing more of those users migrate on-chain, or are we kind of at that same point in the cycle, a few cycles back, where it's still the same concerns, and maybe it's perhaps just the prosumers that are really driving a lot of these volumes?
I guess from our perspective, because we speak to more institutions or high net worth individuals, less so retail. So I think definitely over the last cycle or 2 cycles, we managed to bring a lot more of these folks on chain in the sense that through us, right? So we would offer DeFi products, abstract away a lot of these complexities of dealing with either dealing with staking, restaking, or even farming different points on Pendle, and you can really go down a rabbit hole. But I think our clients trust us to maximize the return for them. So I think which is why a lot of these prime brokers, a lot of these sort of intermediaries exist to cater to these larger institutions who have the capital and the willingness to deploy on chain. But at the moment, I think I touched upon that earlier, right? The infrastructure is good, but for them, right, finding a qualified custodian, being able to deal with sort of like the admin side of things is still very difficult. Maybe Bitcoin ETFs or all of these new things will help address that, but I don't really see that as the same as bringing liquidity directly on chain. So I think our goal is to be able to on the one side, keeping up to date with all of the new developments in the market, working very closely to all the projects out there, and then on the other hand, wrapping them into products directly to our clients.
Maybe Aya, you could give us a pitch on what August does, because from what I understand, you guys do something kind of similar, packaging it into a product for institutions.
Yeah, so thanks, Kevin. Today, August is an on-chain prime broker that's wrapped into a smart contract wallet, and it uses account abstraction, which I promise the panel I will not spend 30 minutes talking about, in order to abstract away the technology and make it just very easy to use, while also customizing the experience both on the borrower and lender side of the equation. So I think to your point, Annabelle, and everyone here on the panel, it takes a long time to build this kind of technology, and I think, obviously with these cycles, people expect it to be built in, 18 months, and the reality, especially with you both being, builders on chain, is that it's just very difficult to do so. And so I guess, question is, what is one thing that you've seen happen, at least in this cycle, most recently on the technology side, that you think has helped abstract away some of the difficulties that the prime desks are basically solving for their clients that maybe can bring more folks on chain?
Yeah, one innovation that's been interesting to watch from a Drift's point of view has been like these experimental forms of liquidity. So we actually have a hybrid liquidity model, and I won't go into depth, don't worry. It's an AMM plus a just-in-time auction and an order book. And what's been interesting is that a year ago, a lot of the liquidity was actually on the AMM side, where there were passive stakers and people who didn't want to do active trading on chain. But this year, we're seeing a lot more activity on the just-in-time liquidity side. And what's been driving this is that there's been a lot more active market makers who have strategies that can tackle kind of the intricacies of doing just-in-time strategies that retail just don't have access to. And what the effect of this has been is that people are seeing much faster fills. They're seeing deeper liquidity, even though that's not present in an order book. So it's a lot more capital efficient than passive staking. So we're really interested to see more and more active market makers come in and close efficiency gaps on our order book.
And does that just in time also work with liquidations on the margin side? Great.
Exactly.
Because obviously a big issue is, when liquidations happen in DeFi, they're very unforgiving, and you will get wrecked. So, Julian, I mean, you've seen this across a number of different products you've built. How would you think about that?
Yeah, I mean, my sort of spicy take is I feel the big thing that has changed this cycle is the proliferation of meme coins. These meme coins are born on chain, and the initial liquidity is on chain. And I think anyone who trades them understands that to win in this PvP game, you just need to be early, so you're sort of forced to be on chain. And yeah, I think if this trend gets really, really big, people will go through these steps of onboarding on Phantom or MetaMask, getting their funds on Uniswap and a bunch of these DEXs. And it's sort of something that CeFi just cannot compete with, because by nature, CeFi exchanges have a listing team, they have a listing process, but anyone can create a market on Uniswap without asking anyone else. So just the nature of it being permissionless means that if there are a lot of these coins getting created every single day, people will sort of have to be forced to be on chain to participate. So yeah, that's a big thing that I'm thinking about and how we can capitalize on that a bit more. But yeah, that is one unique advantage which I think DeFi has over CeFi.
Just to add on to Julian's point, I think we should keep in mind why we're here. We want to give access to financial services to people around the world, and currently that means we need to compete against centralized exchanges, offer similar services, offer similar levels of liquidity, generate volumes that are in the ballpark. But over time, we want to do things that are not capable on centralized exchanges, things that can make things open to people from any jurisdiction who can access liquidity from places where they don't get told no just because of where they live, have transparent liquidation processes or account guarantees that the funds are not being used in a nefarious way. And yeah, so hopefully we'll continue to see more experimentation in this because just being as good as CeFi or TradFi is not good enough.
Yeah, because it's so operationally difficult to onboard into the space today until we abstract that away 100%. I mean, you obviously have products like Athena, which is bringing more of like, the basis product on chain and making it acceptable. Are there any other products that you're excited about? Obviously, your products that you have today, or even Annabelle, when you talk to a lot of your clients, I mean, there's a token that launches a day. So how are they thinking about it relative to the absolute size of the token list that keeps growing?
Yeah, and I think actually I wanted to touch upon earlier that what Julian and Kevin said, it is sort of like the different risk spectrum, so that some parts will be allocated to DeFi because it's potential higher return, so you're more willing to jump through the hurdles to get on board, versus like CeFi, things are maybe more developed, more mature, so the time to liquidity and time to experiment new things is different. The risk involved is different. So I think similarly for our clients, it's the same, right? Some of them probably trade meme coins, but it's nothing. It's probably basis points compared to what they hold in Bitcoin. So going back to your question, I think it would be interesting to maybe unlock a lot of that liquidity within sort of their major holdings. What we can do with your idle Bitcoin or Ethereum, actually more things in Ethereum right now than Bitcoin. So what you can do with those in a safe way. A lot of our clients, they're never going to delegate Bitcoin, put it on some centralized venues. So DeFi is a more natural way for them to be engaged. So there are teams like Babylon or other teams are trying to unlock that. And maybe you can provide native yield directly to your on-chain, right? Bitcoin on-chain. So that's something that we're definitely watching.
Yeah, I think you bring up a really good point, and to the points made earlier, meme coins definitely being the on-ramp into the space for liquidity, but also the liquid restaking token narrative. Pendle, when a Pendle pool has a 60% yield, it's hard to look away from. And so to your point, is that the way that we onboard, these new users into the space? Going to liquid restaking, that's been a pretty big thing. How has that changed over the last 3 months? Any thoughts or hot takes as you have potentially traded it or compared your product to it or helped clients trade it yourself?
I think we're just looking at each other. I think what's interesting with these kind of native assets is that they're actually being generated on-chain entirely. And like for instance, stable coins are like Athena are being generated completely from like an on-chain perspective. They're not like a real asset that's being re-minted on-chain. Meme coins, everything, they all exist in this on-chain spectrum. So what's interesting with LRTs is that DeFi products are actually now serving more like the wealth that's generated on-chain versus wealth that was generated from a lot of these L1 assets. And we're almost becoming like an investment bank for these assets out there. And it's a new type of wealth that we haven't necessarily seen before. And I'm really interested to see what sort of hedging products, what sort of OTC products, RFQ products can be offered for these like natively on-chain assets.
And how do you think about that coming from CeFi and Prime? How do you think about that as these products launch initially in DeFi? And then start to get supported by exchanges, but let's say your clients want access to it beforehand. What does that migration typically look like? How do you value whether or not something's a little bit too risky, like a dog with hat radium pool, or something is perhaps less risky, like a Pendle wrapped ETH token?
Yeah, I think the restaking space is interesting because it's sort of like building a financial market based on sort of solving infrastructure problems, share security, whatnot. So it's not that the yield's not generating from nowhere. per se. There's some basis to it, and it's exciting because it brings like a lot of these financial derivatives that are possible now. So staking sort of introduced the risk-free rate of Ethereum, and restaking is probably introducing more like a corporate bond market where you can choose which ABS you want to delegate to, and based on the risk return. So it's interesting to us as a financial service provider because it really combines both sort of like providing security or infrastructure solutions to Ethereum to actually providing financial products on top. So the way that we explain to clients is also similar in that sense. For us, we offer either native staking, native restaking, or if a client wants access to specific LRTs, then we also will help them understand the risk and reward.
Yeah, I mean, I think the LRT stuff now is very popular because even though, I think that the truth is a lot of these like yield stacking things is pretty safe right now, because stuff like slashing is just not enabled on these protocols yet. But I do think once these protocols mature and you can actually have the risk of losing your ETH by restaking it, I think basically that would change a lot of things. But now everyone's sort of still partying because it's just like free yield and there's no risk of loss. But yeah, I think it'll change a lot in the next like 6 months.
When you think 6 months?
Yeah.
Okay.
Or maybe sooner.
You heard it here first.
Yeah,
Unstake your pendulum in 6 months.
maybe now is a good time for a disclaimer that while we're kind of talking about this stuff, like we have it all figured out, it's very much still in an evolutionary mode. And to borrow a couple of quotes from my friend Matt Huang, we're kind of building a casino on Mars right now, and that's really that's really fun for users. But there's a lot of hard work going on behind the scenes in the engineering space, in the research space, and like ultimately what drives user excitement is what's currently the most important. But over time, things like resilience, reliability, performance, these are going to become more and more important. And yeah, like if inside of this like casino, if it's like a Trojan horse, and inside we just want to create something that can scale to like every user worldwide, whether it's for using crypto for payments or for continuing to trade assets, initially only cryptocurrencies, but maybe later actual securities like stocks, or whether it's for lending and borrowing services. This is what we're ultimately trying to supply, and I think institutions are going to slowly ask for more of this. They're still kind of in the exploratory phase right now. But the challenge for everyone on stage here is to continue to come up with new ideas and to actually build them out, because it's not trivial to do all these things.
Absolutely. How do you think about that as the market opportunity perhaps also decreases as it gets more and more, as more and more of these players, institutional players especially, come on chain? It is, to your point, not sustainable to have a 60% yield, and that likely brings in potential new users, but it's not going to stick around until what we call the next cycle. So how do you think about that changing, and what would you say is your timeline for that?
For my company, things have just been getting harder over the last few years. We were one of the first to invest into building trading strategies on decentralized exchanges, and over time, there's been competitors coming up. First, it was a couple of Dutch guys, in their early 20s, and they're fighting us. And then now it's like the major HFT trading firms around the world, and it's only going to get harder. So our bet is really that crypto will continue to grow, crypto trading will grow, and specifically that on-chain trading will continue to grow at a fast enough rate to compensate for the increased competition. But ultimately, the winners are like the users, the people that get to have access to these services that we're facilitating.
We love to hear that, and
timeline,
we're all very bullish.
Yeah, I'm not sure what a timeline is. I think in the next couple of years, we're just going to continue to see exponential growth and evolution in the ideas that are being tried out. And yeah, there's a bit of a winner's like selection bias of the ideas that do work, but Yeah, I'm just excited to see so many people investing into the space, continue to build in the space, and I think we'll get this figured out in the next couple of years.
Absolutely. Last question, focusing just on 2024. Let's go around the panel. What most excites you about, obviously we have the halving this week, which is going to be a big narrative. We have the ETF narrative, which has been big as well this year. But what excites you most as you think about the next few months? And 2024 can be anything, tech, liquidity, restaking, points, what have you. I'll start with you, Cindy, and we can go around.
Yeah, to the conversation about meme coins, I'm actually very excited about the infrastructure that's being built to support meme coins, because I think it's almost like an unbounded prediction market that anyone can launch in a second. And it's actually created so much efficiency around instant liquidity upon launches. And that's forced us as an exchange to, for instance, really quickly list derivatives around meme coins. So we're super excited about this space because I think it brings in something a lot more fundamental to allowing anyone to create prediction markets of their own. So we're pushed to create innovations around supporting these launches.
Yeah, I think I'm most interested in adoption this year, just from like normie or mainstream adoption. I think basically every major centralized exchange now has their own layer 2 or crypto infrastructure play, which they can funnel their tens of millions of users into. So hopefully, users who onboard into Coinbase and bridge into Base would end up using Aevo at some point in their life cycle. And also a bunch of these new sort of like abstracted wallets, more onboarding stuff like Privy. A lot of these DEXs now actually let you log in with like an email and a password. And they use like encryption and a bunch of stuff behind the scenes to keep your keys safe. So I think stuff like this would make it a lot easier for people to just participate and use on-chain stuff. So yeah, hopefully this year we'll get at least a few more on-chain users, because I think now it's still very small.
Yeah, I think for me it's similar. Like, although obviously we're building a more C5 focused product, but I think my passion's always been DeFi, and then we've come a long way. If you just asked me 6 years ago when I was building AirSwap that we'll talk about potentially trading HFT on chain, that would be unthink of. But I think similar to what Julian said, like more on-chain use cases, maybe it's unlocking more liquidity by utilizing a lot of the idle assets on-chain, or by having new value creation on-chain. Obviously, I think we'll come into a risk management problem, but then I think as every cycle goes, right, we will see through that, and I think maybe that'll happen by 2024.
I think I'm currently very excited about some of the performance scaling improvements that we've made. I guess to echo what Julian said, seeing centralized exchanges like Coinbase develop and spend resources on things like Base, seeing Solana find a lot of product market fit in this meme coin season, seeing next generation blockchains like Monad, who are touting the ability to serve as the bedrock for Ethereum. These are all like the most exciting things to me, because having continued evolution, continuous iteration and improvement, I think this is like the main thing that keeps me excited about the space. If you just kind of froze everything now and then expected everyone to become interested in using crypto, it probably wouldn't last very long. But as long as we have like innovative builders over here, or like OGs who've been helping bring in new attention to the space, I think we're going to be in good shape.
Perfect. And with that, I just want to thank everyone for this incredible panel, and TOKEN2049 for hosting us today. That's it.